Welcome to The Explainer. Right now, the financial markets are telling a really weird story. On one hand, we've got this massive $200 billion cash injection. On the other, the economy is supposedly booming, but a lot of people just aren't feeling it. So what's the real story here? All right, let's dive in and figure it out.
Okay, so first things first. The big headline is this: a whopping $200 billion, and it's being pumped directly into the U.S. monetary system. Now, a number that big, it doesn't just make a little splash. We're talking about a potential tidal wave of cash hitting the markets.
But how does something like that even happen? Where does $200 billion just appear from? It's definitely not as simple as hitting print on a giant money machine. The way it works is actually pretty clever, and it tells us a lot about where all this cash is probably going to flow.
Okay, so here's the breakdown. You've got these huge government-sponsored players, right? Think Fannie Mae and Freddie Mac. They're sitting on a mountain of treasury bills. Step 1, they sell them. Step 2, they take all that cash and use it to buy up mortgage bonds from private investors, people, banks, you name it. And here's the magic trick, the most important part. They are swapping a piece of paper, a bond, for actual cash in investors' hands. That's what we call liquidity. It's new, spendable money flooding the system. And when you have more money chasing the same stuff, well, that's why people are thinking assets like stocks and even gold could get a serious lift.
So this huge wave of cash is about to hit. But what kind of environment is it flowing into? You can't just look at this in a vacuum. We've got to see what the rest of the economy is doing to understand the real impact. And honestly, what the data shows, it's a little bit of a shocker.
Remember all that talk about a slowdown, a recession? Well, forget about it for a second. The latest numbers suggest the U.S. economy is actually growing at over 4%. That's not just good, that's really strong. Way faster than pretty much anyone was predicting.
And look, this isn't just some fluke number. It's being propped up by some really solid pillars. Consumer spending, which is really the engine of the whole U.S. economy, is still going strong. We're also seeing an improving trade balance. We're selling more and buying less from overseas. Plus, the job market is just refusing to quit. It's way stronger than anyone thought it would be. All the arrows are pointing in one direction, a surprisingly resilient economy.
Okay, but here's where things get weird. This is the part of the story that just doesn't add up. Because while all the official numbers, all the hard data looks fantastic, there's another story being told, and it's a much, much gloomier one.
So yeah, this is the big question, the giant puzzle that has economists scratching their heads. How can the economy be growing at 4% with people spending money, and yet consumer sentiment is in the basement? It's this massive disconnect between the numbers and how people actually feel. Let's try to unpack this a bit.
So let's put it on the table. In one corner, you have the hard data, the raw numbers. Economic growth, check, is high. People spending money, check, that's high too. If you just look at this stuff, you'd think everything's coming up roses.
But then, in the other corner, you have how people feel. And when you actually ask them, hey, how are things going? What do you think about the future? The answers are just brutal. Sentiment is near an all-time low. So there it is, the puzzle in a nutshell. Why does everyone feel so bad when the economy is supposed to be so good?
Well, there's no single answer, but a couple of big theories are floating around. First, politics. It's possible that how people answer these surveys is heavily colored by their political views. But there's another, maybe more grounded reason: inequality. You see, while the overall pie is getting bigger, not everyone's getting a bigger slice. For a lot of families, say anyone earning under $70,000 a year, things still feel incredibly tight. The boom just isn't reaching them.
All right, so let's shift gears and look down the road a bit, because it's not just about what's happening today. There are a couple of major wildcards out there, things on the horizon that could come along and completely flip the script on everything we've just talked about.
And these two things are like opposing forces. On one side, we have a potential short-term jolt, something that could happen any day now and really shake things up. And on the other side, there's this slow-burning, long-term problem that could quietly drain all that money out of the system over the next few years.
So this first one is a real head-scratcher. There's a Supreme Court ruling coming up about tariffs. Now you'd think if they rule the tariffs were illegal, that's bad news, right? Markets might panic for a day, but think about what happens next. The government would have to refund all that money it collected. Billions of dollars. Suddenly you'd have another unexpected wave of cash hitting the economy. So a negative headline could, bizarrely, end up being a huge positive for investors.
And this really sets up a kind of tug-of-war for the market's money. Right now, today, we've got that plus $200 billion injection. That's a huge tailwind. But fast forward to 2026, there's this mandate for U.S. companies to pour $100 billion into rebuilding Venezuela's oil industry. Think about that. That's $100 billion getting sucked out of the market. It's a massive, predictable drain on capital that's just a couple of years away.
Okay, so we've got cash coming in, cash going out, good economic data, bad feelings. What are we supposed to make of all this? What's the bottom line here?
This really lays it all out. In the short-term column, things look pretty bullish, right? You've got that $200 billion boost, a strong economy, and maybe even another cash surprise from that tariff thing. But then you look at the long-term column, and it gets a lot more bearish. You have that $100 billion drain coming from the Venezuela deal and that nagging puzzle about why consumers are so unhappy. It suggests there's a weakness under the surface.
And that really brings us to the final crucial question. Right now, the market is completely focused on the here and now. That big splash of cash is all anyone wants to talk about. It's easy to get caught up in that. But the real challenge for any investor is to ask, what's the big risk that everyone's ignoring while they're celebrating today's good news? What's that powerful, slow-moving current that could completely change the game a few years from now?